Did you know that nearly 70% of investors experience losses due to poor risk management? That's a staggering number, but the good news is with the right strategies, you can protect yourself from being part of that statistic and safeguard your financial future. Welcome to today's video, where we're diving into a crucial topic for every investor: effective strategies to reduce investment risks. Whether you're new to investing or have years of experience, managing risk is one of the most important things you can do to achieve financial security and build long-term wealth. In this video, we're going to break down some proven strategies that help you minimize risk while still reaping the rewards of investing. If you've ever worried about market volatility or made emotional investment decisions that led to losses, this video is for you. Let's start by acknowledging the challenges investors face when it comes to managing risk. One of the biggest issues is emotional decision-making. Many investors fall into the trap of buying high during market euphoria and selling low during moments of panic. Fear and greed are two of the most powerful emotions in investing, and without a solid risk management plan, they can lead to significant losses. Another common challenge is market volatility. It's no secret that markets fluctuate, sometimes wildly. And while volatility can create opportunities for short-term gains, it also introduces risk, especially for long-term investors who are looking for stable, consistent growth. The unpredictable nature of markets can make it difficult for investors to know how to react, often leading to impulsive decisions that harm portfolios. With these challenges in mind, how can you reduce investment risk while still working toward your financial goals? Let's explore some of the most effective strategies. The first strategy we're going to talk about is diversification. This is perhaps the most well-known risk management tool, but it's also one of the most effective. Diversification means spreading your investments across different asset classes, sectors, and even geographical regions to minimize the impact of any one asset performing poorly. For example, instead of investing all your money in tech stocks, you might also allocate some to bonds, real estate, and international equities. This way, if one sector takes a hit, the other assets can help cushion the blow, and your portfolio remains more stable. Next is asset allocation, which goes hand in hand with diversification. Asset allocation involves determining the right mix of stocks, bonds, cash, and other assets in your portfolio based on your risk tolerance and financial goals. For example, younger investors with a long time horizon might have a higher allocation to stocks, which offer higher returns but more volatility. On the other hand, retirees might prefer a larger allocation to bonds, which are more stable but offer lower returns. By adjusting your asset allocation as your goals and risk tolerance change, you can reduce the likelihood of taking on unnecessary risk. Another key strategy is understanding market trends and knowing when to adapt your investment strategy based on those trends. While it's impossible to predict the market perfectly, keeping an eye on larger economic trends like interest rate changes, inflation, and geopolitical events can help you make more informed decisions. For example, if inflation is rising, you might adjust your portfolio by adding inflation-protected securities or commodities like gold, which tend to perform well in such environments. Being aware of these trends can help you better position your portfolio to withstand market fluctuations. Additionally, one often overlooked but effective strategy is dollar-cost averaging. This involves consistently investing a fixed amount of money into the market over time, regardless of market conditions. The beauty of this strategy is that it removes the temptation to time the market. When prices are high, you'll buy fewer shares, and when prices are low, you'll buy more shares. And over time, this helps reduce the impact of volatility and lowers your overall cost basis. It's a simple yet powerful way to reduce risk while staying invested for the long term. Another important aspect of risk management is setting stop-loss orders. A stop-loss order is a predetermined price point at which you automatically sell a stock to prevent further losses. For example, if you buy a stock at $100 per share, you might set a stop-loss order at $90. If the stock drops to $90, it triggers an automatic sale, protecting you from larger losses. This strategy is particularly useful in volatile markets or with individual stocks that may experience sharp price swings. Now, let's look at a real-world example of an investor who successfully reduced their risk and reaped the rewards. Meet Sarah, a 45-year-old investor who was heavily invested in tech stocks during the dot-com bubble of the late 1990s. As tech stocks soared, Sarah's portfolio grew rapidly, but she had neglected to diversify. When the bubble burst, her portfolio lost more than 50% of its value. Instead of panicking, Sarah learned from the experience and rebalanced her portfolio with a focus on diversification and asset allocation. She spread her investments across different sectors, added bonds to her portfolio for stability, and adopted a long-term mindset. Over the next decade, despite market volatility, Sarah's portfolio grew steadily, outperforming many of her peers who had stayed concentrated in a single sector. Her story is a powerful reminder of how managing risk through diversification and proper asset allocation can safeguard your investments and lead to consistent, long-term growth. So what are the key takeaways from today's video? First and foremost, reducing investment risk is essential for achieving financial security and long-term wealth. Strategies like diversification, asset allocation, understanding market trends, dollar-cost averaging, and setting stop-loss orders are all effective ways to mitigate risk while staying invested. By spreading your investments across different asset classes and adjusting your portfolio based on your risk tolerance, you can protect yourself from market volatility and emotional decision-making. Remember, investing isn't just about maximizing returns, it's also about protecting your capital and ensuring you can meet your financial goals no matter what the market throws your way. What strategies have you used to reduce investment risk? Share your experiences in the comments below. I'd love to hear from you. And don't forget to check out our other videos on investment strategies to keep learning how to make the most of your money. Hit the subscribe button and ring the notification bell so you never miss an update.